to England, and I realized while I was over there, I hate pharmacy. I'm not knocking all the pharmacists that are on the call. You guys are doing an awesome job. Probably save a lot of lives. It wasn't for me. I happened to get into the stock market, and I've been investing since I was 18 years old. And with my family, we also dabbled in a little bit of real estate investment as well. So I decided a while back, I was working for a software company, and I decided, I want to pursue financial planning, really just to help those, that maybe weren't so literate in their finances or didn't really have all the information available to them. This isn't something that was regularly taught in school when I was in high school. So it really, gave me an opportunity to test my chops at actually trying to help people out. I've been with CIBC now for just under 4 years. I started off as a regular representative, and then I worked my way up to becoming a financial advisor with a portfolio. And then I had a little bit of a shift and switched into this investment consultant role where I help financial advisors advise their clients and build proper portfolios as well as financial planning for our clients. Today, we're going to cover quite a few things. So it's going to be a little heavy, but don't worry. There will be a question period at the end. And once again, my information's there. Anybody that's got a question, concern, wants to, go over things, feel free to shoot me an email or shoot me a text message. And we can always set something up over Microsoft Teams or in person. I like to start off every discussion with a little bit of a joke. A while back, I had an elderly gentleman who, I had been dealing with, for about a year, and he came in December 2018. And I don't know if many of you know, but in that specific month, the stock market had pulled back quite a bit. So while we were talking, I asked him, "How do you feel about your investments?" And he said to me, "Dave, I slept like a baby. I woke up every hour and bawled my eyes out." So I thought that was a pretty funny thing at the time. That being said, today's discussion is going to focus on these 5 points here. We're going to start off by setting a goal for yourself. We'll move on to budgeting towards those goals, and then investing to reach those goals, as well as touching upon credit planning and some mortgage advice as well. So first things first, when we talk about setting a goal, it's very important to quantify those things. Now, I know a lot of you, already kind of know what you want and know what your goals are. For some people, it might be, I want to own a home in 5 years, or I want to buy a house in 2 years, or I want to go on a vacation or buy a car, whatever it is. But it's very important that you set a goal and you stick to that goal. What we typically use in terms of jargon is SMART. We like to set a clear and concise term for our goal. We want to make it qualitative as well as quantitative as well. We want it to be measurable. We want it to be something that's attainable for you as well. If you, don't put those measurements on your goals, really they become open-ended and then they fall out of relevance. We also want to attach a time stamp to that goal as well. So these are just a couple of examples here. So a regular goal might be, I want to pay off all my existing debt and start investing my money. Well, that's awesome, but what's the plan? Have you given yourself a time frame? How are you going to go about doing it? And if we look on the left-hand side there, an actual goal using SMART is, I want to pay off my $1,500 credit card debt within the next 6 months, or I want to save $150,000 over the next year for a down payment on my house. That being said, that's going to take us into our next chart over here, into budgeting. Now we need to budget towards those goals. A budget helps you manage your money better on a day-to-day basis. It allows you to save towards those goals. You do this by tracking how your money is being spent and basically taking in what income is coming in, what your expenses are, where you're losing your money and spending it on things that might not be necessary for you, and then whatever's left over. We live in this kind of lifestyle right now where everybody wants to live that Instagram lifestyle. We get our paychecks, we pay our bills, we want to live our lives, and then we try and save what's left over. 9 times out of 10, we try and flip that around with our clients. We tell them, look, pay your bills, make sure you're doing, all of your stuff on time. But first things first, after you're done meeting your obligations, pay yourself, put money on the side. Whatever's left over, live your life. We still want you to be able to enjoy yourselves. Many people think budgets are no fun, and truthfully, it's not a very glamorous thing to do, but they actually help you do the fun things that really matter to you. Remember, a budget's yours to design. So it's a goal set by you. You know your finances. You can work with a financial planner to kind of see what your cash flow looks like at that point and put money towards your goals. My typical advice for most people is start off small. If you try looking at your budget for the full month right off the bat, things tend to slip through the cracks. Whereas if you work with a budget on a day-to-day or a weekly budget, it'll then become a lot easier for you down the line just to look at your budget on a monthly basis. But it's important for you to start small. I'm going to go on. Now, the benefits of budgeting. Pretty much laid out for you right there. It helps you manage your money better. It tracks the money coming in, the money that's going out. It helps you save towards your goals. And like I said before, it's designed by you for you. With that being said, my typical advice for my clients is follow the 50-20-30 rule. Now, this isn't something that has to be followed exactly, okay? The general rule goes like this. You get your income, you have some personal essential expenses, your home, your transportation, any insurance, food, and utilities and so on. You then go on to your savings, which is about 20%. You use those savings to get towards your long-term goals, whether it's retirement, buying a home, a car, or just building a proper investment portfolio for yourself. And then typically there's 30% left over to go live your life. You buy your gadgets, you can go to the gym. If you're like me, you haven't seen the inside of a gym for the last 2 years. And you also haven't seen any entertainment for the last 2 years, but that's okay. Typically, this is a non-COVID budget. That being said, those numbers don't typically have to be followed to a T. Once again, finances are a very personal thing. You're going to look at your budget, and I challenge you to look at what's left over after you've taken care of everything. Think to yourself, what's more important for me? There's a list of priorities. My priorities are always going to be, what's best for me in the long term. Whatever's left over, live your lives. That being said, I did want to put an example of a budget here. Now that we've kind of reviewed the key elements of a budget, I want to kind of look at an example of what a budget worksheet looks like. As you can see, there's 3 different columns there. Don't worry about the difference so much. What I do want you to focus on is a planned budget versus an actual budget. Once you get to a point where you've been budgeting on a weekly basis and you're now budgeting on a monthly basis, you're going to start looking at, okay, for the next month, this is what I know my income is going to be like. These are my fixed expenses. Really, this is what I'm planning to save at the end of the month. Your actual is going to be what comes at the end of the month. The saying goes, a goal is just a dream without a plan, and your budget is the starting point of your plan. You can use an app, you can use, there's plenty of online calculators that you can use to help budget yourself. But really, I challenge all of you to use a budget, especially if you're trying to build a family or you're planning on getting married. Really, at any point of your life, a budget comes into very good use, okay? Now, there's certain hacks that you can use for your budget. First things first, obviously, spend less on the things you don't need. Once again, it goes back to that Instagram lifestyle. Do I really, want that? I don't know. For me, it's watches. I'm a big watch guy. I think to myself, do I really want to spend $1,000 on a watch? Do I really need it? Probably not. That money could be redirected towards savings. Like I said, use a budgeting app, There's plenty of them online. If you ever do want to use a good one, I have a pretty good one that my wife and I use on Excel. It breaks down everything for us. I also challenge you to get into a habit of looking at all the stuff you have in your home. There's a lot of things that we have that accumulate over time that we don't really need. And it may be worth your time to sell those things and recuperate some of the money that you have in them. And using that money, once again, to put it towards your savings. We will touch on the fifth point there, paying down your debt with the highest interest rate first. At the end, I will talk about credit a little bit as well. But once again, credit card debt is a large portion of the debt held by Canadians. It's also the highest interest earning debt that there is. So really, that's going to be one of the things we touch upon in the credit portion of this presentation here. That being said, one of the easiest approaches to achieving your financial goals is to pay yourself first. You can set up an automated transfer from your savings to your investment accounts. You can also set up an automatic transfer from your checking account to your savings account. Consider your contributions to your savings and investment accounts as a priority expense, just like paying your bills. It's an effective and hassle-free way to save. There's some tips and benefits to paying yourself first. First things first, develop a savings habit. What that does is that removes the temptation to spend. If you know, okay, I'm putting this much money towards my savings and I only have this much left at the end of every month, well, you're going to think twice about making that large, maybe unnecessary purchase for yourself. The main priority of this is putting money aside for your future, as well as creating an emergency fund. Now, there's no specific amount of money that you have to put aside every month. But my advice to most of my clients is starting small, making it regular, but making it a priority. All right. Saving is a great way of making sure that you have financial stability in your life, whether it's an unexpected expense or whether, once again, you're planning towards something. Now, saving for the sake of saving is all well and good, but a typical savings account will not pay you more than maybe 1.5%. There was a time way back when where you could put money in a savings account and you'd earn 10, 15, 20%. But really nowadays, you will not see those kind of percentages on a regular savings account. But that being said, compound growth is a very key element to building proper wealth for yourself. It pays you interest on top of interest, and the longer you keep saving, the more money will be accumulated at the end. The key here is to begin as early as possible and to reinvest all of your earned income or dividends into your investments. Bear with me here one moment. Sorry, my computer just froze. Give me one moment here. There we go. Now, I had said prior to that saving for the sake of saving really doesn't do much for you. Your dollar is actually, in fact, losing value just sitting in a savings account or in your checking account. The goal should be saving to invest. Investing gives you the ability to grow your money very quickly. Bear with me here one moment. There we go. I'm going to use this example here. This is just what $50 a month does for somebody, assuming that we're going to earn about 6% yearly. Now, $50 a month, as you can see, will reach up to $48,000. That's you not really doing anything with that money, just putting it aside. Now, if you're like me, $50 a month, I typically spend that on maybe just coffee sometimes. And you can see bumping it up to $75 a month or $100 a month, that does quite a bit of difference. You can save up to $100,000. Now, we are talking about a 30-year time horizon here, but this is just an example. This isn't really taking into account any portfolios or anything like that. This is just putting money away and assuming a 6% interest rate. That being said, the earlier you start investing, the more you can take advantage of the time spent in the market. With that, I want to talk about these three clients that we have here. We've got Marie, we've got Jonathan, and we've got Sarah. Each one of these is putting away $100 a month in a hypothetical investment that's earning 5%. Now, as you can see, Marie in this case, she starts at the age of 20. She's putting away $100 a month. Her investment over those 20 or over those 35 years is only $42,000. But because she's invested her money, once again, this is just assuming a 5% rate of return. That's not necessarily what a portfolio will get you. But that being said, she's earned about $110,846. That's what her overall earnings are on that $42,000. Jonathan starts 5 years later. And in that same time, he's only contributed $36,000. His $36,000 has more than doubled, but once again, he's missed out on 5 years of growth, and that's only given him a return of $81,000. And once again, we'll move on to Sarah. Sarah starts 10 years after Marie, and you can see she's only contributed $30,000. That $30,000, although it has doubled in value, is only accumulated her $58,000 worth of a return. So you can very visually see how time plays a huge factor. So I encourage everybody, start as early as you can if you haven't started already. Now, when we talk about investing, typically we talk about retirement planning. Most of my clients, especially the younger ones like myself, we don't really think about retirement. It's 20, 30 years down the line for some of us. And really, we're thinking about the next 5 years. We're thinking about the next maybe 10 years. We want to buy a home. We want to start a family. Some of us might want to buy a sports car, whatever it is. But really, when we talk about retirement planning with our clients, we speak to them about overall income sources. Now, as a Canadian citizen, you're eligible for CPP and old age security. Hopefully, you have an employer pension as well. If you don't, my advice to you is set up some sort of a secondary investment plan for yourself. Typically, people also have some sort of personal savings and investments, as well as a job or a rental property. I do have clients of mine that, typically they'll retire at the age of 55 or 60, but they get bored in retirement. So they take up either a hobby or they take up a job. Really, I emphasize to all of you, and I emphasize to all my clients, is you don't want to be in a position when you want to retire and enjoy your family and enjoy traveling and all that, but you still have to work. So really, it's going to come down to how you build your overall investment portfolio. It's going to come down to your real estate. It's going to come down to any pensions you may have. CPP and old age security will never be enough for you to retire on. It's just an added amount. So typically what I would suggest is don't even bank on that. The way the Canada Pension Plan is run, there are some hedge fund managers from CIBC that do advise the Canada Pension Plan. There are concerns over the amount of overall funds available for future generations, with the baby boomers retiring soon as well. But that being said, these are the 4 sources of income in retirement. If you have a business, most of the people in the crowd, if they're pharmacists or lawyers or engineers or something, if they have a business that they've set up, they can then hand off that business or choose to retain an ownership of that business. And that's another revenue stream in retirement. Moving on, investing is a tricky process. There's many different ways of investing. If you're saving money, you want to make sure it's working for you and it's being invested in the best vehicle possible. So I kind of want to talk about the basics of that. For some of you, this is just a refresher. For others, it may be new information. But investing is when you buy a product, such as a fixed income product, an equity product, or a mutual fund with the intention of making a higher return. Different investments give you different returns on the money that you're going to earn. They also have a different amount of risk, which is the potential of you obviously losing the original money that you've put into them. A key thing is always going to be understanding how time factors in with risk and how you feel about your investments. Most of the time when I'm talking to my clients, especially over the last month when the market has been down significantly, it's helping them to manage their emotions. Here's a couple of examples of investments that you can use. So we have high interest savings accounts there. It provides a better return than a standard savings account. It holds many of the same benefits as a savings account, such as the flexibility of being able to access your money. It gives you a predictable interest payment, and it gives you the ability to kind of grow your money without too much risk or loss. That being said, though, it's typically the place where you're going to earn the lowest amount of a return. When we take a step up from there, we look at things such as bonds. Now, bonds are I'll dive into them a little bit deeper, but think of a bond as a loan. They're typically short to medium-term investments. Now, I'm going to just go forward on my slide here just to explain what a bond is to you guys. So a bond is a fixed income instrument. It's used by governments, companies to raise money and by borrowing from investments. Think of them like a loan, as I had said, and they can vary between low risk and high risk. There's different kinds of bonds as well. There's corporate bonds whenever they want to, fund an expansion project or research or development. There's municipal bonds issued by a city or state to fund a project like a school or road or hospital. Typically, municipal bonds are untaxed. That being said, there's also treasury bonds. These are issued by the US government. They're risk-free. Because of the low risk, they do not typically pay out a high yield. And then there's junk bonds as well. These are what we call low credit rating bonds. They offer very high returns, but they also have high risk, and the issuer of that bond could default on you. And then we have bond funds, which are typically mutual funds that are made up of different bonds. That being said, a good majority of you are under the 35 to 40 range, and this isn't an investment that I would suggest typically for a younger person, but it may be a good part of an overall portfolio for yourself. Moving on, we have things such as GICs. Now, a GIC is called a guaranteed investment certificate. It's secure, very low risk. Your principal is 100% protected. So, for example, if you put $1,000 into a 1-year GIC that's paying out 2%, you're guaranteed to get that $1,000 back, regardless of what happens in the market, regardless of what happens with the bank or anything like that. But that being said, you can see that even if they're 1 year, keeping your money locked in there, you're only going to earn a $20 return, which isn't very much. It's important for you to also know that bonds typically are they can be flexible or they can be locked in. A flexible GIC, a flexible GIC gives you the ability to access the money at any point you'd like. They typically pay out interest every 30 days or so, but because they are flexible and they're not locked in, any bank or financial institution is not really going to give you a high rate of return on it. A locked-in GIC, your funds are completely inaccessible until maturity. Now, this poses a problem. If you need access to that money, you're not going to be able to get it unless you go through, you have to submit something called a financial hardship form, or in the God forbid somebody passes away or anything like that, then you'd be able to access the money. Interest is forfeited if you break that GIC prior to the maturity date. Once again, not really a holistic approach to your long-term investments, but this is something that may be good if you're trying to save your money. You may be buying a house in a year or so and you want to save your money, make sure it's not risked, there's no risk in it, and earn a little something on top of it. Moving on, we also have ETFs and mutual funds. Now, ETFs or mutual funds are very similar in the sense that they are a pool of they're a pool of clients and money from those clients. Okay, there's many investors in each one of these things. It is a basket-like investment. It holds hundreds of stocks, bonds, as well as other currencies as well. So I'll give you an example. A mutual fund can hold, for instance, I have a tech mutual fund. You can own Microsoft, Google, Facebook, NVIDIA, a bunch of different companies under one portfolio. Now, buying each one of those companies individually will cost you quite a bit of money, but buying them under a pool allows you to buy a portion of them and not have to spend a lot of money on one share. Now, mutual funds and ETFs can be either equity-based, fixed income-based, or balanced funds. They both charge fees, but they both have the ability to diversify your portfolio. And you're going to hear that term whenever you talk to any financial advisor, is they're going to tell you, diversify yourself. You don't want to put all of your eggs in one basket. There is a higher degree of risk with mutual funds and ETFs, but keep in mind that within these ETFs and mutual funds, there's lower risk or more conservative funds, and then there's high risk as well, and everything in between. So you can kind of tailor make your portfolio with a mixture of these or one of these. You can always reach out to me afterwards as well if you have any question about specific ETFs or mutual funds as well. The breakdown between an ETF and a mutual fund, on an ETF side, it's commission based. So typically what will happen is, if you are buying a stock, whether you're with CIBC or TD or Bank of Montreal or Wealthsimple, they will charge you what's called a brokerage fee. It's the same thing with an ETF. It's like buying a stock. You will pay a little commission price. If you're paying more than $10 per commission, I would suggest looking elsewhere to trade your portfolio. An ETF is a lot like a stock as well, where it's actively traded throughout the day. The price actually changes several times a minute. For instance, right when market opens, it could, a specific stock could be $15 a share, whereas 2 minutes later, based off volume or based off, any news that's come out, it could be $13 a share. The same thing happens with an ETF. ETFs are primarily passively managed. What that means is there's no hedge fund manager that is actively buying and selling and reallocating stocks on a daily basis. They're usually just plug and go. ETFs are traded on every major stock exchange, such as the NASDAQ or New York Stock Exchange. A mutual fund charges something called a management expense ratio. It's a percentage of the total amount you have invested for that time period. For example, if I put $100,000 into a mutual fund January 1st, and the fund charges me 1%, I will pay $1,000 for the management fee of that mutual fund for the full year. Mutual funds are bought and sold once per day. They're not actively bought and sold on the stock market like ETFs are. That price that we calculate is based off a net asset value. Net asset value just looks at the overall price of the fund, minus any liabilities, divided by the outstanding share price of that fund. Mutual funds are typically actively managed, although there are passively managed or index-linked mutual funds as well, and they can only be purchased by the issuing financial institution. Moving on, I'd like to point out here that when you're investing and you're trying to build a portfolio for yourself, it's going to be very important that you factor in time. I'll give you an example. If I bought stocks in beginning of January and 2 weeks later that stock price dropped down 15 or 20%, I will feel it immediately. But if my plan is not to touch or to look at that money for another 3, 4, 5 years, I'm investing for the longer term, well, it's not really going to matter to me if it drops 10%, because I already saw value in this investment before that. And now that it's at a cheaper price, I'm not going to sell it, because if I sold it, I would be assuming the loss in that moment. Short-term volatility is a reality of the stock market. I'm sure all of you have heard the news. The markets have gone down. They've recuperated a little bit recently, and people typically get a little antsy when they see their investments go down. A long-term investment strategy according to your investment goals and risk profiles is important. Investing in the market can be highly rewarding as long as you have the patience and the discipline to withstand the bumps in the road. Equity markets are greater investment risks than fixed income investments, but historically, equity markets have higher realized returns and have outperformed all other investments over the long term, having more than compensated investors for any losses or even inflation. And I will touch upon inflation at the end of this as well. Short-term volatility is a reality, despite declines caused by various historical events. For instance, the 2008 Lehman Brothers collapse. Markets have made subsequent recoveries in the years that follow, demonstrating that the market's long-term resilience is there. Long-term investing is more of a marathon than a sprint. Keep that in mind. I will say this as well. We have clients typically come in at every market dip and they tell us, what do I do in this situation? You have to ask yourself, really, what is the goal here? If the market pulls back 10%, are you comfortable eating a 10% loss on a stock that you saw value in at one point already? Or is this an opportunity for you to either hold and keep your investment for the longer term, hoping that it'll come back in value, which we've seen historically is typically the course, or would you sell and assume that loss and try and recuperate it someplace else? And typically, as any financial advisor will tell you, or any investment consultant would tell you, it all comes down to the emotional aspect of it. Now, investing is a very important thing, but it's also very important to understand how you're going to invest. I'm sure a lot of you have heard what a tax-free savings account is and what an RRSP is, but I'm going to dive into how you can use those accounts a little bit, okay? Bear with me here. This is a comparison between a tax-free savings account and an RRSP, okay? Up until this year, if you have been a citizen and over 18 years old, from 2009 to this year, you will have accumulated $81,500 worth of contribution room to your tax-free savings account. It's very important for you to verify what your contribution limit is with the CRA. Any unused contribution room from years prior, you can then carry forward to the year that you're in. So I'll give you an example. If last year I wasn't able to contribute $6,000 to my tax-free savings account, knowing that this year the government has given us another $6,000 worth of room, I can then contribute $12,000 this year to my tax-free savings account without penalty. A tax-free savings account is not tax deductible. What that means is the thought process behind a tax-free savings account is you're investing with after-tax dollars. That means you've already paid your taxes on it. You're going to put your money into this tax-free savings account. And the government at that point says, you've already paid your taxes on it. Now, any growth that you see in your tax-free savings account that's then withdrawn is completely tax-free. Now, with a tax-free savings account, you can hold all kinds of investments. You can hold mutual funds, you can hold ETFs, individual stocks, bonds, and GICs, or you can leave money sitting there in cash. But remember one thing, a tax-free savings account is one of the few places in Canada that you can see proper growth in your investments, withdraw that growth towards whatever your goal is, and not have to pay the tax man a dime, which is huge. With that being said, there is a penalty if you over-contribute to your tax-free savings account. The penalty is typically 1% per month, which doesn't sound like a lot, but everybody will tell you, why give the CRA more money than they're already taking from you, okay? There is a tax-free savings account also doesn't have an age limit on it. There is an age limit on starting one. You have to be 18 years old and have a valid SIN, but unlike an RRSP that has to be converted down the line, a tax-free savings account can be held until you meet your maker. So in this regard here, we do have a lot of retirees that have RRSPs and tax-free savings accounts, and we work with them to mitigate some of the taxes from their RRSP towards their tax-free savings account. And we'll go over that as well. An RRSP can be made up of a number of investments. Same thing, you can hold a mutual fund, stocks, GICs, or you can keep your money sitting there cash. What makes this account unique is that it allows your investments to grow on a tax deferred basis. You pay no tax on the earnings and growth within your RRSP until you start withdrawing the funds. You can use the funds in your RRSP to help with the purchase of your first home, and we'll touch upon that later on, or your post-secondary education if you want to pursue a master's or a PhD, and not pay tax on those withdrawals either. An RRSP could be a good way for you to meet your retirement goals and immediately reduce your taxable income. What I mean by that is every year you contribute to your tax-free savings account, you can deduct up to 18% of your earned income up to a maximum of $29,210. So let's look at that for a moment. If you've earned $100,000 a year, knowing that the 18% is the cap, and you contribute that $18,000 towards your RRSPs, you will not pay taxes on $100,000 of income. You'll pay taxes on $82,000 worth of income because you've used that contribution room in your RRSP. Unused dollar amounts can be deferred to another year or pushed to another year. But my advice to you is, instead of waiting at the end of or waiting for tax season and trying to get together, a huge amount of money to put towards your RRSPs, setting it up on a regular basis may be a better option for you. An RRSP does have an age limit on it. Now, by the year you turn 71, in December 31st of that year, an RRSP must be converted or withdrawn. Converted could be into a retirement income fund, which is then a closed facility, meaning you cannot contribute to it anymore. You have to start taking it as a income on a monthly basis. The thought process behind this is that when you're retired, you may not be making as much income as you were when you were working. Withdrawing that X amount of dollars or that minimal contribution on a monthly basis towards your retirement ensures that you're not going to pay tax on the full amount sitting in your retirement income fund. You're only going to pay tax on the portion that's withdrawn. That allows the rest of your money to grow in a tax-free manner and only paying taxes on what is withdrawn. If you have any questions about RRSPs or tax-free savings accounts from this point, feel free to message me afterwards or leave your questions to the end as well. Whenever we're talking about investments with our clients, before I go ahead, I will also tell you a tax-free savings account or an RRSP is not the only way that you can invest in stocks or mutual funds or ETFs or anything like that. There is a non-registered, what we call a non-registered account, which is essentially not a tax-free savings account and not an RRSP. But the drawback of a non-registered account is all of your money or all of your gains are taxed. Any dividends are also taxed. Your interest is also taxed. So I will eventually do a talk based off the tax consequences of each one, but primarily for this discussion, we're going to stick to RRSPs and tax-free savings accounts. It's important for us to factor in inflation into any investment decision that you're going to make. Even at low levels, the Bank of Canada typically tries to target anywhere between 2 and 3% for inflation. It can still impact your long-term spending power. The real rate of your return you're getting on your investments is calculated by the return on your investment minus the inflation. I'll give you an example. Up until a few years ago, inflation was in the 2 to 3% range, which was fine because if you were earning 10, 15% on your portfolio or 10, 15% on your investments, that meant that you were walking away with about 12 to 13%. The issue that we have nowadays, and COVID has brought this on, not to get too much into the politics of it, but COVID has spurred an environment where every country in the world is seeing an increase in inflation. What does that mean to you? I know many of you might not actually know what inflation is, so I'm just going to quickly touch upon that as well. Inflation is basically the purchasing power or loss of purchasing power of each dollar that you have. So judging by this chart over here, we can see inflation in real terms that mean something to us over the last almost 30 years. So in 1980, a liter of gasoline was 29 cents. By 2017, it was $1.18. Now, I know this chart says by 2025, it's going to hit $1.38. Well, we're in 2022 now, and it's almost $1.60. And by April, we could be seeing $1.90. So any investment that you make is going to have to factor in the loss of purchasing power being inflation. Inflation nowadays is probably closer to, I mean, the Bank of Canada will tell you it's 4.75%, but that doesn't take into account the cost of housing or cost of purchasing something like a used car. We know that house prices over the last 2-3 years have gone completely berserk. I looked at a property today that I saw listed last year, and it was listed at 2.1 last year. This year, it sold for $3 million. That's a $900,000 difference. It's a tough thing to try and incorporate that into your inflation rate there, right? So real inflation is probably closer to 6.7 or 7%. So any investment that you have it's very important to ensure that you're earning a decent return, at least keeping up with that 6 to 7%. Now, I'm going to have a quick discussion with you here about credit. I'm going to leave the investment conversation for now. And if you at a later date or at the end of this, you want me to dive a little deeper on any of the investments or anything like that, we can go over that at that time. But I'm a firm believer that there are two parts to your financial planning. Yes, one of it is budgeting and investment planning, but the other part of it is credit planning. A lot of people don't really know how credit works in Canada. So I'm going to quickly touch upon certain things that I think would be really useful to all of you. So let's talk about what your credit is actually based on. A credit score starts anywhere between $300 and $900. I will go ahead and tell you right off the bat that if you have, I've dealt with people that do have, not so good credit, and there's always a way of making it better over time. It's not easy, but it is achievable. Typically, most banks that see clients that have credit ratings of more than 700 or 730, they will make it very easy for you to get access to extra credit at sometimes lower interest. Your credit score helps us kind of visualize what your ability is to repay back your loans. And when you're looking at a credit report, usually there's only two large companies in Canada that create credit reports, and that's Equifax and TransUnion, and you can always approach them to get your own credit report. But a credit report kind of tells us as lenders, what does this client have outstanding? Do they have 5 credit cards with $10,000 owing on each? How have they been repaying those debts? When did you open up your credit card, or when did you open up your credit facility, and how much you owe, any missed payments, and so on. It's very important for you to be conscious of your credit profile. A client that has 4 or 5 credit cards to us is a red flag right away. My advice to you is always keep, 1 or 2 credit cards at the most, and have them at reasonable limits. Something that's anywhere between $15,000 or $20,000 is fine if you own a home, because you may have to make a purchase or something might come up, and that's okay. But if you're a student and you have a $15,000 or $20,000 credit limit, that makes us question, okay, well, what are they doing with that, right? That's a lot of money for them to be able to pay back. So those are things that I think that you should keep an eye on. And going forward, let's think about really what impacts your credit score. Well, right off the bat, we know that if you make any late payments or you miss any payments, that's a red flag to us. Okay, well, if it happens once or twice, really not a big deal. But if it's happening regularly on a month-to-month basis, that tells us that there's some sort of struggle that's there. Another thing that'll affect your credit is if you have any of your credit accounts set to collections. That's a very, very bad thing for your credit. You definitely do not want to be in collections. It's always better for you to reach out to the institution that you have debt with and say, hey, listen, I want to work on a payment plan with you guys. Another thing that we factor in is how long have you been using your credit? So if you were 18 or 19 years old and you got your first credit card and you still have that first credit card, awesome. You've got a long established credit history, which is very good. We do look at that as well. We'll also look at how much you're paying on your bills and how much you owe. Another thing is that we do see this a lot, especially when people are trying to buy a car or shopping around for a mortgage. We actually track, well, not us, Equifax and TransUnion actually track how often you're applying for credit. So if you're going to Costco and getting a Capital One Visa, a Capital One credit card, and then you're going to Sears and getting, well, Sears isn't around anymore. You're going to Canadian Tire and you're getting another credit card over there. That's also a red flag to us. So it's very important that if you're shopping around, you really don't do too many credit hits on your profile there. The other thing that we'll talk about is the types of credit that you have. If you have a good mixture between a mortgage, a line of credit, and a credit card, and you're making payments on those things and you don't have high balances owing on those things, that's also very good for you. It gives us the ability to say, hey, this is a good, this is somebody that we want to lend our money to, and we know that we're going to get a return on our investment there, on our debt there. There's three different types of credit that you can own. There's credit cards, there's loans, and there's lines of credit. Credit cards and lines of credit function in the exact same way, but have different uses and different details about them. Obviously, credit cards have the highest borrowing cost to consumers. Credit cards should typically only be used for day-to-day purchases and paid off before your statement date. So I personally have not used my debit card for the last probably 6 years of my life. I use my credit card for all of my expenses, but I ensure that those expenses can be paid off at the end of the month. And really what that shows is, hey, listen, I can borrow money, but I can also pay it back. It's also very important for you to weaponize your credit. If you have a credit card where you're not getting points or you're not getting cash back, that's a mistake. Use that credit card, get some points, get some cash back on it. There's a wide range of credit cards that are available. Some have annual fees, some don't have annual fees. There's student cards, there's personal cards, there's business cards. Have a talk with your advisor about what card is best for you. I would suggest shying away from using your credit card for extremely large purchases. For example, if my wife and I bought a mattress when we first got married. Well, I didn't use my credit card. I used my line of credit. Now, a line of credit is the same thing as a credit card. It's what we call revolving credit. It offers you a flexible payment plan. There we go. It offers you a flexible payment plan, and it provides you an ongoing way to access that credit. There's two types of lines of credit. There's secured, meaning that it's secured by a home, which is typically used as collateral, and then there's unsecured lines of credit. An unsecured line of credit will typically have a higher interest rate than a secured line of credit. We also have student lines of credit as well. For clients that are going off to med school or optometry or anything like that, there are special rates that we do talk about with those people. And then there's an investment secured line of credit. We have certain clients of ours that have a good amount of money saved up or a good amount of money invested with us, and then they can actually borrow money using that money using their investments as collateral. Tips for building good credit. It goes without saying, only spend what you know you can pay back. Pay it on time. Make sure your phone bill's paid on time. Make sure your car payment's paid on time. If you have a balance on your credit card, try and pay off as much as you can of that balance if you can't pay the full amount. Never exceed your credit limit. If you've got $10,000 limit on your card and you go over that $10,000 limit, that's an immediate red flag on your profile. So the thought process is keep it below that limit. Any cash advances as well typically are looked upon poorly as well. And check your statements regularly. A lot of us, we kind of just pay off our balances at the end of the month without actually looking about what we spent. And actually, been lucky enough to be able to catch fraud on my card just by looking at my credit statement over the last month. Most big banks have an insight program in their mobile banking, which gives you, kind of a coach to help you with your debt struggles or anything like that as well. And if you have any questions about, whether it makes sense for you to do a debt consolidation, which means putting all of your debt in one facility, just reach out to me and we can go over different solutions with you as well. Now, why did I discuss investments and then credit? There's a huge thing here where, if you're like me, a lot of my friends want to buy their first property. They see it as this large investment, which is a good thing. The home buying landscape right now is very aggressive. Unfortunately, a lot of people are being priced out, and we know that housing right now has become somewhat unattainable for people. If I've bought a property and I'm selling it, and I'm selling it for $600,000 more than what I bought it for, I'm assuming that whoever is buying that property for me is going to be qualified for that extra $600,000. And that's not always necessarily the case. It's very important for you to start thinking to yourself, okay, well, how do I get into that first home? And there's a few things that I think would be beneficial for you to keep in mind as well. The first thing that I would say is what you need to figure out what you need to qualify for a mortgage. I'm going to focus on these 4 points here. First things first, look at yourself and look at your partner's gross annual income. I'm not talking about after-tax dollars, before-tax dollars, because whenever they're calculating how much they can lend to you, they're always going to look at your gross, not your net. They're also going to look at your employment history. If you've been with your employer for, say, a year or less, that's going to be tougher for the bank to say, hey, he or she has job security, let's give them that big mortgage, okay? Obviously, it goes without saying, your credit history plays a huge role in how you're going to get qualified for that mortgage. Another thing that we look at is your debt to income ratio. How much existing debt do you have? And is your income sufficient enough to cover that debt, including the debt of your mortgage? There's some important things that you need to have an honest conversation with yourself. First things first, determine what you can afford. Sitting down and looking at your overall income and then looking at how much you have saved up and all your debts, it's always in your interest to kind of think to yourself, okay, well, I've got this much saved. This is what I'm going to put towards a down payment. And then I'll talk to a mortgage advisor, or I can talk to a real estate agent who can refer me to a mortgage advisor and kind of get an idea of how much I can actually get approved for. Your considerations are always going to come down to your household annual income, your down payment size, the amortization period, and I'll go over those terms with you quickly as well. But we also take into account, when we're qualifying people for a mortgage, any closing costs that they may incur, property taxes, home insurance, as well as utilities and so on. So that all that is factored in when you're applying for a mortgage. The government of Canada has given us quite a few incentives here for purchasing your first home. The first is your first-time home buyer. Your first-time home buyer is a utilization of your RRSPs to withdraw towards your first home. And I'll go over that briefly as well. And then moving on, we also have our first-time home buyer's tax credit, as well as our first-time home buyer incentive. And I'll touch upon each one of those as well. With your home buyer's plan, any first-time home buyer can withdraw up to $35,000 tax-free from their RRSP to buy or build a home. To avoid any tax consequences, that $35,000 withdrawal has to be paid back in a 15-year time period. If you have a spouse or you're engaged and you're buying a property together, you can both utilize that $35,000 RRSP for a total of $70,000 down. whenever I'm talking to a client who's just bought their first property and they're repaying back their RRSPs, because they're paying it back over 15 years, they're not going to come back and just drop down $35,000. We do set up what's called a regular investment plan with them, and we typically invest that money into some sort of an investment according to their risk profile to ensure that the money that's being repaid is also growing for them faster than the rate of inflation. The first-time home buyer's tax credit is a non-refundable tax credit that allows you to claim up to $4,000 on your taxes when you buy your first home, as long as it's done within 180 days of purchase. There's a new incentive, and this new incentive is called your first-time home buyer incentive. It's available now, which helps qualified first-time home buyers reduce their monthly mortgage carrying costs without increasing their down payment. Qualified home buyers can apply for 5 or 10% shared equity mortgage with the Government of Canada. I typically do not advise going this route, but it is an option for those who want to get into their first property really badly. Now, there's some terms here that I think would, make sense for you to know as well. Amortization refers to the length of time it's going to take you to pay off your mortgage. The term is the contract that you have for the interest rate on that mortgage, and that term can vary. It can be a 1-year, a 3-year, 5-year, or 4-year mortgage, or even a 10-year mortgage. The longer your amortization is, up to 30 years in Canada, obviously the lower your payment will be, but your interest cost over that time will be much higher. A shorter amortization will typically mean you pay off your mortgage sooner, and you're paying less interest, but obviously your payments are a lot higher. Now, it's important that you familiarize yourself with some of these terms and options that are available to you here. We hear the term all the time, a fixed mortgage. What is a fixed mortgage? It's a mortgage where the interest rate is fixed and doesn't change on you. A variable mortgage, on the other hand, has an interest rate that fluctuates based on what the Bank of Canada's prime rate is. Currently, the Bank of Canada's prime interest rate is 2.45%. If many of you don't know, the Bank of Canada met recently and they decided to keep it at that. They will not be raising it until maybe March. I would expect that in March that will go up, meaning that obviously your mortgage costs will also go up as well. A closed mortgage basically means there's a limited prepayment privilege, which means that if you have any extra cash or anything like that, you cannot dump it into your mortgage. Whereas an open mortgage, you can pay up to 100% of the balance at any time with no prepayment charges. Most Canadian large banks have a prepayment privilege on any closed mortgage. Typically, it's up to 10 or 15%. Check with whichever lender you plan on borrowing your mortgage from. They'll tell you what you're eligible for on a yearly basis there. Now, moving on, I'm going to talk to you briefly about what a high ratio mortgage is and what a conventional mortgage is. When it comes to your down payment, it's a very tricky mortgage landscape right now. A down payment of less than 20% basically means that you have to insure your mortgage. The rate to qualify most borrowers is the Bank of Canada mortgage qualifying rate, which I believe right now is about 5.25%. That means that even if your mortgage rate from the bank is say 2.5%, they're still going to qualify you at 2% more than that. A conventional mortgage typically has a 20% down payment. There's no insurance on it. The rate used to qualify buyers is the exact same thing as a high ratio mortgage there, where we do have a 5-year benchmark rate that from the Bank of Canada, or your contractual mortgage rate, which means that if you are borrowing at 2.5% from the bank, they will qualify you at 4.5%. It's important for you when you're looking at buying a property to remember that there's some closing costs, or there's some fees that come around as well. There could be home inspection fees, property valuation fees, legal fees, realtor fees, sales tax, land transfer taxes, although if you're a first-time home buyer, you don't have to worry about, plus any moving fees or closing costs. That's typically the one place where I find people forget. They forget, oh, I might need an extra $15,000 or $20,000 at the end of when I close on my property to ensure that I have all my basics covered. The thought process is usually you want to leave about 2% of the overall mortgage amount in cash so that once you close on your property, you have that sitting there. Your mortgage or buying a property is one of the largest things that you're going to do. So it's going to be very important for you to have some sort of insurance on that. I'll give you an example, and then I'll leave it at that. When I first started working at CIBC, I did used to do mortgages as well. I had a lovely couple with 2 kids. They came in and I did their mortgage for them, and I pretty much told them, it might make sense for you to have some sort of mortgage creditor insurance as well. The husband and wife both took it. They took life insurance. They didn't take any disability. About 8 months later, the wife called me and said, "Hey, I need to come and sit down with you." She came in. I could tell right away she wasn't, very happy. Their mortgage was about $700,000 at the time. And her husband was the one that was the primary income earner in the house. She was a stay-at-home mom with the 2 kids. Unfortunately, he passed away in a car accident. And it was a very sad thing, but there was a silver lining there. He did have his mortgage insured, and her not having an income at the time, actually CIBC completely paid off her mortgage. So she got her property, the $700,000, completely paid for by the insurance on that. So it's always something that I suggest, keeping in the back of your minds as well. And if you have any questions on the different types of insurance, I can always have one of my colleagues come in on the call as well and go a little deeper on it. Now, I kind of put this whole kind of diagram together for everybody, just so that if you are in the process or you are thinking, I do want to buy a property at some point, there's really 3 steps to it, right? The first and foremost is obviously assess your finances and make sure that you surround yourself with a good realtor, a good mortgage broker, and a good financial advisor that are going to give you proper quality advice without beating around the bush. You don't want somebody who's just going to sit there and tell you what you want to hear. You want to hear it like it is. Prepare for your meeting. Once you've assessed your finances, you're going to go in there. Hopefully, you've already been budgeting, so you kind of already know this is what I've got saved up, and this is what my income is, and these are what my expenses are. At that point, you will determine what you're qualified for. And then once that's done, then you can start talking about affordability options. You work with your realtor, you find properties that are fit within your budget, and then you place an offer on a property. At the end of it all, you'll finalize and submit your mortgage application. We will do a property appraisal, and then you'll get final approval, and hopefully you'll enjoy your property. With that being said, I did want to take, there's closing costs as well. Almost forgot that. Your lawyer will have to do the legal fees as well. Most big Canadian banks actually have in-house legal fees. Shouldn't cost more than about $600. And then you'll close on your property and hopefully get to enjoy it for the rest of your life. At this point, I do want to take this opportunity to say thank you to all. I know that I kind of threw a lot of information at everybody. Typically when I'm talking to my clients, I only focus on one thing at a time, but I thought it might be good to touch on the overall process with each of you. And then at some point, if you do want me to dive a little bit deeper on certain things, I can do that at a later date, or you can feel free to reach out to me. I also want to take this opportunity to thank the host over here, Christine and John and Philo and everybody that's made this possible. And I hope that you've all learned a lot from this. My information's at the front. If you'd like anything, please give me a call. I'd be more than happy to help. Do we have any questions?
Yeah, thank you so much, David. So what we're gonna do for the questions for those who are online as well as in person, you get to go to pollev.com and then enter SMSV 018, and then you can be able to answer questions, and I can just read the questions.
I like what Louis said over there. He said, yeah, January was not a fun month on the markets. Buy the dip. He's not wrong.
Definitely.
Do we have any questions?
Yeah, so we have an in-person question, so I'm just going to hand over the mic.
Sure.
So thanks for the talk, by the way. It was really informative. I guess, and this is like a tough one to have, and I only bring it up because I went through it a couple of years ago.
Sure.
But did you talk to like kids around our age, like, you know, just starting to get established, start your own family, about estate planning with respect to your parents? Because all of us, God bless our parents, but they're all getting a bit early.
Yeah.
They're all getting a bit elderly, and maybe depending on your family situation, they're not comfortable talking about their finances with you, and you don't know their situation, and God forbid something happens, but you know, not having a proper estate plan can make things a lot messier than they have to be.
So you're not wrong at all. Estate planning is one of the kind of cornerstones that we talk about whenever we have any clients come in. Quite honestly, I still do estate planning with clients, even if they're kind of just starting off their life. I don't typically go to that client and say, hey, bring in your parents, let's do some estate planning, because that's a little morbid. But any clients that have children or grandkids or anything like that, we do have that discussion with them. We do urge them, you know, have a plan in place. Make sure you've got a beneficiary on your tax-free savings account, or RRSPs, or a successor on your tax-free savings account, or your RRSPs. Typically, when clients do get a little bit older in age, we do advise them, if they have a good relationship with their children, to make them joint on some of their checking or savings accounts. What that does at that point is it ensures that, God forbid, if somebody passes away, the other person just typically inherits that account. But estate planning is a huge thing when it comes to overall financial planning. We do discuss that with them. And like I said, we talk at the minute we find out that there's, you know, any investments or kids or grandkids or anything like that, that discussion has to take place. I also urge everybody, you know, I know you know, most of the people I'm talking to are younger, but have your investments, have your accounts, have all that stuff. Make sure that you have somebody that you trust, that you've looped into this. And I'm not talking about friends. I'm talking about your mom or dad, or your sister or brother or anything like that, just until you're married. And then when you're married, you're going to laugh, but I do the investments, and I do the, you know, all the aggressive, you know, growth tactics for my family. But my wife is actually the one that runs the budget of the house. She's the accountant. She's the one that says, hey, you spent too much last month. Let's have a chat about this. Just typically because she's much better organized than I am. But you need to have an open dialogue about your finances. For some reason, you know, we grew up saying, you know, it's something that we shouldn't talk about. Maybe it was different for me. I'm an only child. I was very involved in my parents' finances from the time I was 18 years old, but that discussion has to take place. So I don't know if I've answered your question or not, but I hope you got something out of that.
No, you did. Thank you. And I just think, yeah, it's like you said, it's a hard conversation to have with our
It
parents.
is.
But at least starting, it doesn't have to be like
Yeah.
open, direct, you know, show me everything.
No.
But at least,
No.
you know, opening the lines of communication, I think, can be really helpful, because
It's also, you also have to think to yourself, like, if we get to, like, you know, God forbid you know, one of your parents gets to a point where they can't take care of themselves, or they're in hospice, or they're whatever it is, it's going to be a huge pain for them to try and get all that stuff done down the road, right? It's better for you to have that unfortunate, or that really tough conversation first and foremost, and then deal with whatever comes afterwards, right? But I do strongly advise, estate planning is a huge thing for us as well. I did see a question here in the chat. Would mortgage insurance cover you if you get laid off from your job? If so, for how long? Is there any other info you can share regarding to that? So actually, funnily enough, there is, I don't typically deal with it myself, but I know that there is mortgage insurance that deals with disability, job loss, and so on. They won't directly pay out your mortgage. They'll typically make payments for you on that mortgage. that was Amira. I can always send you some information based off that as well. Just feel free to shoot me an email, and I can send you some information based off that.
That's good.
Thank
So we're
you.
getting a lot of questions here ever since the opened up the poll. The first question here is, what are your thoughts on taking out a line of credit and use that money to start an investment portfolio?
So that's funny because I do that quite a bit. That is called leverage trading. So you're borrowing money to invest. And then keep in mind that there are benefits to that, because there's benefits and there's drawbacks. You have to figure out that balance yourself. But the key takeaway here is, if I'm borrowing money, and let's say I've got a line of credit that's 3% interest or 3.5% interest, but I can take that money and put it into a portfolio where I'm earning 20% interest, then you know what? It makes sense, right? As long as you're comfortable having that debt hanging off your shoulders and you can service that debt, there's nothing wrong with that. Leverage trading is great. I'll give you an example. Back, it was March 2019, when COVID first came out and the stock market pulled back, 20, 30%. I borrowed money off my line of credit and bought Canadian banks and bought Enbridge and bought a bunch of different stocks that I had seen value in prior to, and now I was buying them on a 30 or 40% discount. So I didn't have that kind of money sitting around in cash. It was tied up in my investments or in my mortgage or whatever it was. So I just borrowed money off my line of credit, but I was comfortable knowing that I could pay back that line of credit even if I lost that money. So keep that in mind.
Good point. Make sure that when you're investing that you really have the feel for it too. Yeah. The next one is, or a lot of them is actually regarding to like the housing market. So, or buying a house. How much does it cost for a lawyer to close a house, or that lawyer fee?
So if you're getting a mortgage through CIBC or RBC or TD, one of the big banks, they'll typically charge you a appraisal fee and a legal fee. Now, that appraisal fee is going to be anywhere between maybe $250 to $450, depending on where you go. And the legal fees will be anywhere between $600 and $800, depending on where you go as well. That's typically all you will pay in terms of the legal fees. The bank will typically take care of everything. The bank's legal department will typically take care of everything from you, for you at that point.
Wow, that's really cool. I didn't even know that they could take care of that as well.
Yeah. I actually saw an interesting one here from Louis. I hope I'm saying that right. Most of the young people I know put their money into stuff like cryptocurrencies, NFTs, and meme stocks. Do you think that what they're doing is financially prudent? I would be a hypocrite if I told you I didn't dabble in any of this stuff myself. But to say that this is my long-term portfolio, this is my investment, my main investment and all that, is quite honestly very risky. You're buying things that they don't move unless there's volume behind them. There's no balance sheet, there's no underlying factor that's really moving these things. Tomorrow China can come out and say, hey, we're not doing Bitcoin, we're not allowing it in our economy. The US central bank can come out and say, hey, we're not allowing any cryptocurrencies, or we're not accepting them, or we're not, whatever it is. The whole point is that can crash them very quickly. But do I think that holding crypto and all that is a bad thing? It's not, as long as you have your main portfolio set up and you're invested in things that are value driven. By all means, go and dabble on that stuff, but it should not be your main investment portfolio. I'll give you an example. I'm a firm believer that you have that baseline portfolio that you know that you are going to revisit once every 3 to 6 months, at most every year. That's invested in big blue chips, dividend earning stocks. And then I have what's called my belief investing portion. So I have my regular portfolio, and then I have some money that I invest on my own. Now, up until a few years ago, my portfolio was worth more than that little portion that I was investing in on my own. Well, now I've reached a point where that investment portion is much bigger than my portfolio. And now I feel comfortable saying, okay, let me be much more risky. And let's put some money in Bitcoin. Let's put some money in Ethereum. Let's see if we can do an NFT and sell it. And you know what? That stuff, you can make money with it. But to have all your eggs in that basket is very dangerous.
Agreed. No, there was another comment on the audience as well. Do you have anyone in Zoom? Is anyone in Zoom?
Oh, yeah, I see one here that from Marie. Do RRSPs differ from bank to bank? Also, are the funds locked in unless you're using it for a down payment for a property? So an RRSP, think of it as something that's closed off. The only time that you're going to touch that RRSP is if you're going to buy your first home, if you're going to go pursue a master's or a PhD, or in retirement. So your RRSP should be thought of as long-term unless you're planning on buying a property right off the bat. Now, RRSPs don't necessarily differ from bank to bank. It's just that the investment that you buy, CIBC could have their own mutual funds, RBC will have their own mutual funds, but the actual holdings of those funds will be very, very similar. For instance, a tech mutual fund from CIBC will kind of reflect the same tech mutual fund from Royal Bank. It's important for you to know that you can have multiple RRSPs and tax-free savings accounts at many different institutions, as long as your overall contribution limit on the tax-free does not go over the cumulative 81,500. You can have as many accounts as you'd like. But if you go over that 81,500, you'll start being penalized on it. Same thing goes with your RRSP. You as long as your contributions stay within the limit, you can have 2 or 3 different, 5 different RRSPs. It makes no difference, right? Once again, I don't advise that because if you have more than 1 or 2, it becomes very hard to keep a track of them.
Okay, so we have one in the audience here. Okay, so here.
Yeah, so I know you said you didn't really want to talk about strategies in this one. This is more like kind of overall knowledge, but
Sure.
I guess did you want to talk about maybe the depending on your age, kind of the strategy of RSPs versus TFSAs? Like, I don't know, I always thought as you're younger and maybe you're still establishing yourself and your salary and your career, a TFSA makes a lot more sense than an RSP. Because yeah, you're not making that much to begin with. You don't really have to worry about taxes.
For sure. So the younger crowd that comes in, typically, we will talk to them more, or we'll emphasize more tax-free savings accounts than RRSPs. We will still talk about RRSPs when we talk about their holistic approach to investing, kind of thing. If they haven't bought their first property yet, then yeah, we'll talk to them about an RRSP. But yeah, my emphasis is typically on a tax-free savings account. Usually when I have an older client come in, they already have RRSPs or anything like that. We talk to them about, some tax strategies on how to take the minimum contribution from your RRSP, maximize your contributions to your tax-free savings account to ensure that once your RRSPs are depleted, you have that tax-free savings account contribution room. I will also say this: RRSPs for people that started way back when can grow to become 7-figure accounts, right? I've seen clients that have $1.5, $1.7 million in their RRSPs. I've also seen clients that have, 100 or 150,000 bucks in their tax-free savings account. Our age group is going to see our tax-free savings accounts grow to the size of those RRSPs at some point. So I think, obviously, to answer your question, younger crowd, obviously we will talk to them more about a tax-free savings account, mainly because if something comes up, they can access the money right away. They don't have to worry about any tax consequences or anything like that. So to answer your question, I hope that answers your question.
Thank you. Yes, it does. So another question that we have, just back to the line of credit. Is there any way to pay the down payment from my line of credit?
So that's tricky, okay? I'll give you an example. I have used my line of credit before to put a deposit on a condominium. I paid off that line of credit before I had to apply for the mortgage of that line of credit, of that condominium. The reason is that when you come to apply for a mortgage, they're going to look at your credit and they're going to see that line of credit sitting there outstanding, and they're going to say, okay, well, what are you going to do about that? Are we looping that into your mortgage? Well, then you have to qualify for it. And if that line of credit is still sitting there with the balance on it, that's going to eat away from your mortgage lending ability, right? So yeah, like nowadays let's say you buy a property that's not being built for 2 or 3 years, and your initial pay structure on the condominium or house, whatever, is say 15,000 now, 2 months later, another 15 grand, and then down the line, another 15 grand, and so on and so on. If you find that you can hold on to that line of credit and pay it down before your next payment, by all means, go ahead and do it, right? I've used that in the past, but like I said, I typically have to pay down that line of credit before the next payment is due as well. So just keep those things in mind. I hope that's answered your question.
Thank you. So back into kind of the housing market and timing. With the current state of the housing market, especially that you've mentioned in the presentation, do you think it is wise to buy a property now, or do you believe that the market will cool down later on?
That is a loaded question. So traditionally speaking, we have to ask ourselves, you have to ask yourself, that property that you're going to buy, is it going to be your home, or is that going to be an investment for you that you're trying to flip? The reason I'm saying that is because right now, obviously, house prices are sky high. If you're buying this place as a home for yourself and you want to put down roots there, it really doesn't matter what happens in the short term. It's more about what's going to happen in the long term. But if you're buying that place as an investment, you have to think to yourself, well, we know the Bank of Canada hasn't raised rates just yet, but they will be raising rates slowly over the next few quarters. That being said, the GTA is kind of a funky place when it comes to housing. We have really no supply of housing. There's an area that my wife and I love near where we live right now that we'd love to buy a house in. I haven't seen a house for sale there yet in 30 days, and the ones that do come up are sold for $400,000 or $500,000 over asking. So I do think in the short term, you may see a slight cool down in the real estate market. I don't think you're going to see a pull back in the real estate market, meaning I don't think you're going to see, prices drop. And if they do drop, it won't be drastically. And you also have to think to yourself, if a house or a condominium over the last year has earned 20% in appreciation, what if the market pulls back 5-10%? That just puts you back at what the prices were 6 months ago. If you're buying that place, the odds are is that you're not going to close on it for a short, quite some time, and there's room for it to appreciate further. But do not get caught up stretching yourself to a point where you're buying a property and then you end up house poor, because that's a different ballgame altogether. But I do think that the GTA as a whole, unless the government comes in and says, hey, we're opening up a bunch of green space and go ahead and build on it, I still think supply is going to be a huge factor in the real estate market, and I don't think property values are going to drop drastically in the long term.
Thanks. Good eye opener. Yep. So we got a follow-up question. So just a second.
Sure.
So based on that, and like you said, it's impossible to tell, to see if prices would ever go down. But, a lot of people, nobody wants to rent, right? Like everyone wants to be a homeowner. But,
yeah,
the more you think about it, what the prices are, what they are, there's a lot of value in renting if you can get the right rent price where it can actually be, or what are your thoughts on that, I guess?
So I'm not a fan of paying somebody else's mortgage off. I'm just not. I don't like it. I want the ownership for myself, right? Keep in mind, once you have a property, I'm sure, look, there's a lot of value in renting. One of the things being peace of mind, knowing that, I don't have to worry about my mortgage renewing. If something goes wrong with the property, it's not on me. You can call the landlord, that kind of stuff. But really, what happens when the landlord finds out that he can get an extra $400 or $500 a month and doesn't want to renew your lease, right? But going back to what I said, I'm not a fan of paying off somebody else's mortgage. When you have a property, even if you're buying it at these kind of levels, which, let me be clear, what's happening in the GTA is insanity. What's happening in the housing market in general is crazy. But as I'm paying off my house, I now have this asset that I can borrow against to further my goals. So I'll give you an example. You have $1 million property that's paid off. You go to the bank and the bank says, hey, we can approve you for a $500,000 secured line of credit that you can convert into a mortgage at any point. You can use that $500,000 to go buy another property. You can use that $500,000 to go invest in a portfolio. You can use that 500 grand to start a business, or you can use that 500 grand to go buy yourself a Lamborghini, right? At the end of the day, you have a property that you can borrow against, and then that line of credit can be converted back into a mortgage. And yes, you will have a mortgage, but at the end of the day, you have something that you can borrow against and leverage into something else. So ultimately speaking, I don't really like the idea of renting, but it's becoming more and more of a reality for a lot of us. And once again, I think a lot of us need to have a honest conversation with ourselves. Whereas 10 or 15 years ago, if you got married, your first property was going to be a single detached home. Nowadays, your first property is probably going to be a one-bedroom apartment. That doesn't mean that that's a bad thing. It just means that this isn't your forever home. This is going to be a place where you're starting and you're going to pay it down. And then either you're going to sell it and hopefully you've paid down some of it and you've earned a little appreciation. You can use that to your next property, or you can remortgage it or refinance it, rent it out. Now you have a property that's rented out, and you can use that refinanced amount to go put a deposit on something else. So I do think that there's more pros to buying a property than renting. But once again, finances are a very personal thing. I had a really good friend of mine who chose, for the first 4 years of her marriage, they just chose to rent. And that made sense for them. They didn't really want to be tied down. They didn't really want to worry about home ownership and all that stuff. But eventually they moved that way, right? I hope that's answered your question.
Yeah, it did. I was thinking more kind of in the month-to-month costs. Like typically for one property, the monthly cost of rent will be cheaper than the full cost of owning that property. So
if
you don't want to overextend yourself,
for
you
sure,
could rent that property, and then the actual difference between the mortgage and the rent,
invest
that could
it.
be savings or investments.
For sure. I will also I would suggest kind of looking at two properties that are one person who's renting a property and the other person who owns the exact same property. The rule of thumb is for every $250,000, your mortgage is once again, given what the interest rate is and all that stuff, this is just a ballpark, but let's say it's about $1,000. So every $1 million, the rule of thumb is that your mortgage is going to be in and around $4,000. Look at what a one-bedroom condominium is being rented out for, I don't know, at Young and Shepherd. That condo is being rented out for what, $2,500 a month, $2,700 a month, depending on what other facilities come with it. A property that's $600,000 or $700,000 is still going to cost you, about $2,500 to $3,500. You have to ask yourself, is that $500 to $800 difference every month? Is that going to be worth it for me to have some ownership, or do I want to take that $500 to $800 or even $1,000 difference a month and go and put it into a growth portfolio or into savings or something like that, right? That comes down to you. There's no advisor that's going to sit there and tell you this is the right way of doing it. This isn't the right way of doing it. Ultimately, if a client places more benefit on something for themselves, then they should do that. My role is simply just to say, hey, these are your options. This is what I would do in this case. And really, ultimately, you come to the conclusion on your own. But I do see the merits of rent. Once again, it's not something that I typically advise. I hope that's kind of answered some things.
Yes, thank you. We do have a handful of questions. So another one is it possible to get a 5% down payment as a gift from a family member or friend? And then just to add on that, do you see that happening very often, and what are the implications?
So it's funny. I don't do mortgages anymore. And it's funny that I'm getting a lot of the mortgage questions, but I do know quite a bit. I have seen, especially more recently, I have seen people get gifts from their parents or from their grandparents or an aunt and uncle. Typically, you can use that towards a down payment of a property. You would have to get a gift letter. Basically, they would be saying that they're not expecting this money back. And if you guys would like, I can actually kind of schedule a shorter mortgage discussion with them. I have a partner of mine that does mortgages as well. There's also some very good mortgage guys at SMSV that I refer to sometimes as well. But like I said, you can use a gift letter for your down payment of your property.
Thank you.
Has that answered it?
Yeah, I think it pretty much answers it in that case. Another property question, in speaking of which, of trying to find mortgages, is it the same amount that I get from a bank if I just pay the 5% down payment, or it will be like more or less if I go to like another bank, for instance?
Sorry, say that. Run that one by me again.
So is it the same amount I can get from any bank if I just pay the 5% down payment, or it will be different?
So typically speaking, it will be relatively similar from the big Canadian banks. So anytime you're talking about the big 5+1, which is CIBC, TD, Scotia, Royal Bank, Bank of Montreal, and National Bank, there are very, very close similarities or very, very minute differences between what you can get in terms of a mortgage between each one of them. What it will come down to is the interest rate, okay? Now, you can alternatively go to a B lender, right? And they may offer you more money at a higher interest rate. At that point, it'll be dependent on whether or not you want to go down that route or not. I encourage everybody, don't just look at, this is the property that I want, and I'm okay to go to a B lender or a private lending or anything like that to get the money, because really that's how you end up house poor. So you can always shop around, it's fine. You can always ask anybody at any one of those banks to say, hey, I want to do a pre-qualified mortgage application. Not a full-blown mortgage application, but something that gives me a pre-qualification, just so that I can get an idea of how much I can borrow from you.
Good tip. You definitely don't want to be house poor in that case as well. Yeah, we're actually getting a lot of love here. One person is saying to please be their financial advisor. We also have another person that mentioned as well is, what is the percentage like for a financial planner consultant to review my finances and help me with a plan?
So I will tell you, if you are a CIBC client, a RBC client, a TD client, you don't pay anything to sit down with one of those individuals. All you have to do is give up some of your time. The biggest issue that I have is when I'm trying to get a hold of a client to go over their investments. I'm not asking them to pay me anything. The bank pays me. It's not coming out of your pocket. It's coming out of the banks. I mean, you are paying management fees on any mutual funds or portfolios or anything like that, but you're not paying me. I'm not going to charge you extra. It's just a part of my job. And my advice to you is just setting up, a regular habit of being in touch with whoever your financial advisor is at whichever institution you're with. But at least once or twice a year, you should be reviewing your entire portfolio, whether it's just your checking account, savings accounts, credit cards, lines of credit, mortgages, investments, the full thing. You should be reviewing those at least once or twice a year. The thought process is that your life is constantly changing. Your investments and your debt and all that stuff needs to reflect where you are in your life. My example would be, if you're young and single, when I was young and single, I'm still young, but when I was single, I was very aggressive with the way I invested. To me, it was like, if this stock, basically bottoms out tomorrow, it's gonna suck, but it's not gonna be the end of the world for me. Well, I'm married now. I have a mortgage. I have, responsibilities, and I also don't want my wife to get mad at me. So I'm not going to be as aggressive, right? I'm still very aggressive with my investments. I just have mitigated the risk a little bit.
Good point. Two more things. So in regards to something that we can, or a lot of us could relate to, is if you have student loan, do you need to first finish that loan before investing in other things?
Not at all. Not at all. You need to think to yourself what your cash flow situation's like. So if you are earning enough money that you can pay your bills, you can pay your line of credit down or your student loans down and invest, you should be investing as well. The odds are is that student loan, the interest rate on it is probably going to be lower than a credit card or a high interest line of credit or anything like that. And you can offset some of that with your investments. Keep in mind, the younger you are, the easier it is for you to be much more aggressive in the way you invest. That's when you can put yourself in ETFs and stocks and mutual funds at a high, at an aggressive kind of degree and earn, anywhere between 50 and 25%, depending on what kind of funds you're on and stuff. Now, keep in mind that brings more risk, but because you're young and you don't have the obligations, it's okay, right? Once again, what works for some people doesn't work for others, but that's the general consensus.
Got it. And last question on the poll everywhere here is, do you have to fully pay off your mortgage to be able to refinance?
Not at all. Not at all. So you got to think to yourself, to pay off your mortgage is going to probably take you 25 or 30 years. If you've bought your property, I'll give you an example. If I bought a property at $500,000, after 5 years, I've paid off $100,000 worth of that 500 grand. Okay, so I have a $400,000 mortgage. In that same period, my mortgage my property value has gone up to $1 million. Well, now I have $600,000 worth of equity in my property and a $400,000 mortgage. I can then go back to the bank and say, hey, I want to access some of that equity in my property. Can you tell me how much I qualify for? And at that point, they will go over your debt servicing ratio, and they'll say, okay, well, based off this, we can give you, let's say, a $200,000 line of credit or a $300,000 line of credit. Keep in mind, folks, that banks will typically, if you pay your mortgage off completely and you go to the bank, they are still not going to give you more than 65% of the total value of your home as a line of credit. The maximum you can get is 65% as a line of credit against your property, but that's still a lot of money.
Can I ask a question, David?
Please.
So far, like I've been thinking, like of the Canadian banks that is always investing with them sucks. Like, for example, GICs, like they always, like renew the rate on the lowest posted rate, for example, like the mutual funds, aggregated funds, they're just limited options just to investing, aside from real estate, of course. Like with the stocks and stuff, you always need to educate yourself, or else you're going to be losing a lot of money. You're screwed.
For sure.
On a parallel universe, when you think about just highest interest or rate of return, and you think about back home, for example, other banks back home, they give you like 12, 13%. So what are options that in Canada that exist that you can think about, or at least put a plan that really give you a good rate of return or good interest that can be like a good road of investment?
So I will tell you, I am not a fan of GICs for long-term investing. If you're doing something less than a year, knock yourself out, do a GIC. There are investments though, there are mutual funds, there are ETFs that pay out a very good rate of return. I'll give you an example. I have one growth fund called the NASDAQ Indexed Fund. Okay, it just tracks the NASDAQ. It's passively managed, mostly passively managed, and it tracks the NASDAQ. The average return over the last 10 years has been about 24% year over year. Now, all it does is it tracks the NASDAQ. It doesn't do anything else, right? But had you put that in there 5, 10 years ago, that's not a bad return at all, right? And keep in mind, you have the benefit of investing here in Canada versus back home is that if something happens back home, and I know Egypt's paying great interest rates on savings accounts and stuff like that, but if something happens, how are you going to get your money out? How are you going to ensure that that money comes back to Canada without having to worry about the currency being devalued or anything like that? At least over here, if you've built a proper portfolio for yourself, you can mitigate some of the risk. You can still strive to get a greater return as long as you're okay with taking on more risk. And your money's right underneath you. And the benefit of being in stocks or ETFs or mutual funds is they are highly liquid. That means that today, if I bought a mutual fund and tomorrow it jumped 20%, I could sell it and take that 20%. right? If I buy a stock on my own and that stock jumps up 15, 20%, I can quickly take that money out. It's not locked in whatsoever, right? So I don't know I don't know if that's kind of answered some of your questions, but my advice to you, and honestly, the biggest thing that I find is that most people haven't sat down and spoken with somebody who, like, quite honestly, is giving them all the options that are available and ensuring that they understand what those options are, right? Most people tell you, yeah, here's a GIC, you want to put your money in, you want to, oh, I'll put it into a tax-free, but they don't actually talk to you about why you should do this, or hey, these are your options. And that's really, a good advisor is worth his weight in gold. I'm a heavy guy. I'm fat. So that's a lot of gold. But my point being is that you just need to make sure that you're sitting down with somebody who's going to lead by education. Once you understand, then the plan is put on place. And most importantly, that plan is being revisited on a semi-annually or annually basis.
Great, great, David. Thank you so much.
All right. And feel free, Amir, if you'd like to, give me a call sometime. I can do a Microsoft Teams meeting with you and show you a bunch of different options. Okay.
That's amazing. Thank you so much, David.
My pleasure.
I'm looking forward to that. Thank you.
No problem. I did see a question from Peter Henna. Peter, I saw your question. I do have a guy on my team who deals with, he's a business advisor, so he can actually answer that a little bit better for you. But feel free, let me, if you can, shoot me an email with that same question. I'll post it to him and then I'll get back to you about that.
Appreciate it. Thank you so much.
Not a problem. Did we have any other questions?
So last call for questions in 10 seconds. Okay, we actually have one coming in.
Okay.
Yeah. It just seems to be a repetitive from the previous question.
It's okay.
Okay.
So there's another one on Zoom. There's another question in Zoom. If you guys want, I can read it. If by the end of the year you find yourself with an extra money, would you recommend putting it in the mortgage or keep it in your savings?
That's a good question. So I want you to think about it like this. If let's say at the end of the year you come up with an extra $10,000 or $15,000, if your mortgage is less than, let's say your mortgage is 3%, okay? But you can put that money into an investment that will earn you, let's say conservatively, 7 to 8%. Why not? You're going to make 5% on that money and still be able to cover the mortgage, right? So it's all about the trade-off. But remember, peace of mind is also a very big thing for people in their finances, right? For some people, that mortgage hanging over their head, it keeps them up at night. But if you're still making those mortgage payments and now you have extra money, well, my advice to you would be use that money towards something that's earning you more than 3 or 4%, whatever your mortgage rate is, right? That's really my 2 cents on that. I hope I answered that.
Yes. Is there any further questions? And then we're just going to be wrapping up right now. Okay.
Give me one moment here. I'm just going to go back to the main screen so people can kind of, I don't know if you guys can still see my screen or not, but this is all my information here.
Perfect. Everyone, take a screenshot. All right. We'd like to thank you so much again for presenting. It was quite informative. I love the step-by-step, breaking everything together, mentioning all the definitions, as well as being really personal and actually answering all the questions, and then bringing it even back to your own experience as well.
I would like to say, like, I know once again, I know I threw a lot of information at all of you, and sometimes it can be overwhelming. But the whole idea is that I just want you guys to get a general idea of things. You're going to come up with your own questions, and at that point, you can reach out to me at any point, and I can try and answer them for you. I don't have all the answers, but I do work for an organization, and I have a great team that does have all the answers.
Amazing. Yeah, the teamwork makes the dream work, exactly. And back to the goal being, or a dream just being a goal without kind of, it has to be smart in that case. So just kind of like some concluding remarks, some announcements just to wrap things up. If you have any feedback or any topics you'd like to suggest in the year, let us know at crew@smsv.ca. So that's crew@smsv.ca. As well as everyone who's in person. If you walk out there, there's also a small feedback box and topics that you can put in, so we can ensure that we take everybody's consideration and really make something, not only is it relevant for everybody, but something that you guys want to attend as well. We're also opening up positions for volunteers. So we have a lot of volunteer opportunities, because a great team can't be a great team without you people, as well as your feedback and your participation. And then we're having our series, our tune-up series. Next week, we're going to be having our mental tune-up. So be sure to come here. It's also going to be in person. And the social is going to start at 8. And then the actual talk will be at 8:30. So in that case, we're all good to go. And we're just going to be standing up for a quick prayer.
Thank you.
Thanks. So in the name of the Father, the Son, the Holy Spirit, one God, amen. Thank you, God, for bringing us all here together and to filling our hearts with joy and gladness in your presence and coming together. Ensure that you protect and help those all in need, and to spread your word throughout the world. Through the intercession of St. Mary and St. Ignatius, here's what I say with all thanksgiving. Our Father, who art in heaven, hallowed be thy name. Thy kingdom come, thy will be done, on earth as in heaven. Give us this day our daily bread. Forgive us our trespasses, as we forgive those who trespass against us. No temptation, but deliver us from evil. In Christ Jesus our Lord, for thine is the kingdom, the power, the glory, forever and ever. Amen. Father, the Son, the Holy Spirit, one God, amen.